Morning, guys. Welcome to the quarterly Hobart. Our second meeting focusing on the first quarter of 2023, and I'm excited to review and go over the market in terms of what's happening in your businesses as well. And today we have Blair Turner, Kyle Brown, Albert Hu, and David Zerner with us. And we'll kick off with just some general business in terms of what's been going on across each of your businesses, particularly over the last 3 months, whether there have been any changes of note. To start with, and we might start with David in terms of what is anything significant happened from a buyer's agent point of view?
Yeah, it's been an interesting first quarter. We got off to a slow January, which is probably as expected until we hit Australia Day and inquiries started to flood in. And contrary to the last 3 months of last year, we had very little interstate inquiry. So that started to really pour in late January. And then February was we actually had our biggest month of new inquiry and clients coming on board and sort of securing their property. I think it's, the positivity out there was, beyond my expectation from buyers. They're looking for lifestyle, they're looking for investment opportunities, they're looking for development land, they're looking for inner city Airbnb. The big theme is coastal. They definitely want coastal rather than inland. So there's some really interesting themes coming in, and more for me it was more high level investors, and they're more articulate. They'd come with set criteria and set requirements they wanted out of their purchases. So, and then I suppose on the flip side, the family buyers and first home buyers, they're all about due diligence now, all about getting in some clauses, making sure the right property is purchased in the right location, because now they have some more choice. So that was really the first 3 months, and through February was enormous. March was wonderful. And it hasn't stopped, so I think we're going to see that continue flowing in. The interest rates hasn't stopped buyers feeling positive. Albeit we've had 10 increases in a row. So on a discount perspective, we're about $72,000 discount per property purchased at the moment. That's up nearly double from last year. We're about 37 to 42,000 increase on a discount on a price of a property that we purchased. So we can see that vendors are happy to accept a bit of a lower price than is asked or market value, and buyers are happy to negotiate.
Is that national or sort of?
That's Hobart centric. Hobart centric, yeah.
And it's still not that significant issue given we've come off a 30+% increase in 2022.
I agree, and we're working day to day with agents and vendors about yes, we're not asking for huge discounts or unrealistic. We're actually just trying to set what true market value really is in this market, and that's hard on any side of the spectrum to realise. So,
Oh, thanks, David. That's really good. So we'll touch on interest rates shortly, but Kyle, from your point of view as a financial planning space, has there been anything that's stood out in the last 3 months? What's your business been looking like?
So for me, speaking about two segments of clients, there has been no shortage of locals talking about retirement planning and really entering that journey into partial or full retirement. No shortage of that. And they certainly are spending more than we've seen over the years. There's no doubt about the cost of living, and also the desired standard for living has increased. It's a bit of both, definitely. It's not just people getting lost in expensive shopping bills, grocery bills. It's definitely a bit of that, insurance bills, those types of things, but also lifestyle desires I perceive from retirement. There's a lot of travel, there's a lot of doing things with grandkids, there's a lot of finding the right house and the right lifestyle fitting place to live in, doing little things to their house, that's leading to, we've got a lot of people talking about retirement, entering retirement, and we've got people spending a fair bit of money in retirement. It was only a few years ago that the average in our business was people talking about 50 grand a year should do it, and it's quite quickly we've got people now talking about 100 grand a year in retirement. That's net after tax. That's above the national average, but the national average has increased. I haven't got the exact numbers, but the national average was like a really comfortable lifestyle. Might have been, I can't remember now, 54 or something only a couple of years ago, and now that's closer to 68.
Right.
National average.
Is that for like a couple?
That's a couple. That's a comfortable lifestyle for a couple.
Yeah.
Comfortable for a couple. I can bring it next time what the actual standards are, which come every quarter. So there's that pocket, and that's definitely been the busiest segment. The other segment is on the accumulation side, younger accumulators, people with successful jobs or more so successful businesses. A trend there, people who are making large contributions to their retirement planning, to their superannuation, they're still planning on doing it, but they're holding on for the end of the financial year, especially in the small business side of things. There are things, I'm a bit concerned, we've got a few less inquiries, this, that and the other. Gosh, my insurance bills are bigger, interest rates are having a bit of an impact. We're still going to hit that number, the cap being 27,500 generically as far as the ATO goes, but whatever their plan is, we're still doing that, but we'll stop doing 2-3 grand a month, and we'll just catch it up in May, June.
See where we're at.
We've done 15 or whatever. In May, June, we'll just hit it with a one-off lump sum of whatever the number is. So there's been a bit of a trend of that. And I don't know if don't think they're actually hard-pressed, so to speak, more so cautious based on what they believe they're seeing in lower inquiries for their business, increased expenses for their business, noting insurances and interest rates.
Yeah, no, very good, Carl. That's excellent. From a accounting point of view, Albert, what's been happening in your business the last 3 months apart from heaps?
Apart from heaps, yes. Probably the highlight from the accounting point of view maybe cybersecurity issues. That's no doubt about that. Unfortunately, it's across nationwide, across the board anyway. Then ATO probably, is very busy chasing around their tails and trying to, solve the problem. And also, because of this sort of issue, my personal feelings about is ATO's got extended the compliance for the next year. It'll be interesting to see what's the next budget turn up, which is not far away, right? In May, I believe so.
Yeah, May.
So personally, I don't think that there should be any major changes in the new budget, believe it or not, because of the country needed money to fix the deficit, even though it probably may not be paid off even for the next couple of generations. Because I think we're slightly over $1 trillion sort of debt. Next
That's
year.
right. Yeah.
But looking at that number, I think if we get 1/9 of this, and maybe fix the problem. But that's a separate issue. In terms of with Carl, you brought it up the contributions. Yes, I've seen fairly large super contributions in 2022 financial year, but probably expected maybe 2023 in the coming. By the end of 3rd of June this year, there will be another wave of a larger super contribution.
Do you get a lot of clients? So come to May, like Kyle was saying, and topping up and waiting till that end.
Correct.
Yeah.
Yes. We do have a lot of clients. Almost every. Still depends on the client's demographic sort of profile. Say people who's over the perfect age normally would be around 60 to 67, because during that bracket you don't have to satisfy working test, as we all know. And for the people who actually was in that stage normally have sufficient assets. But again, some of fair chunk of clients, however, they always have a asset rich but cash poor. I got a fair bit of client make half a dozen phone calls yesterday only, talking about the super contributions and the assets. And there is a trend for in terms of selling a super fund. Some people probably can't again, that's probably largely depends on because of ATO's more compliance regulations, rules, and everything. So a lot of relatively senior trustees of certain super fund probably lost the plot. Said, look, it's too difficult for them to cope the enormous amount of compliant requirement. So I said, no, I'm willing to wind up the fund. I've got probably four funds we wind it up by the end of this year. But I can see the increasing number of funds, a smaller scale of fund. We're talking about probably assets maybe overall less than $500,000, particularly with one beneficiary. That's probably wind it up because of the cost and effect overall.
Was not quite right.
Exactly. So and these people probably they're talking about on the other hand, some people, we're not talking about selling a super fund, we're talking about super fund in general. Still, a lot of people interested in pouring a fair bit of money into the super industry, I reckon. They're talking about, a lot of people are talking about the home downsizing contributions. Yeah. And again, the downsizing contributions, yes, is a bit of a reasonably straightforward, but still a bit of a curly scenario cases where, maybe partially exempt or not 100% exempt as long as you got it. The concept of downsizing contribution of home from principal plate residence is pretty broad, put it this way. Relatively broad. It's broader than initially when you have a bit of a glaze and something. Yeah, that's simple, but it's actually it's relatively broad. And I can see the trend still probably putting people, making a large amount of contributions, winding up something super fund, more compliance, cybersecurity. That's the highlights. Yeah. That's the highlights of the last probably 3 months.
Yeah, no, very good. It sounds like a lot there. And the other thing too, just on that superannuation, with the last few months, how the government's just correct me if I'm wrong here about the changes to the tax that applies to the more high end of town. I can't remember what was the threshold. 2 million plus. What was it?
2 million.
3 million.
Person, so
right.
They want to roll out a tax on higher super balances.
Yeah.
And it's if as an individual, if your balance is 3 million, and this is quite interesting in terms of that only affects they believe a small percentage of Australians, and so if your balance is over 3 million each year, they've got a formula which they will tax you on, and it will be taxing not just income but unrealised gains. And so in this forum, something that's relevant is people with self-managed funds, and in particular property. So you still own the property, you haven't sold the property, but you get to the end of the financial year and there's a calculation on paying tax on any gain on the property. So that let's just say that for simple terms, you had a $3 million property in a self-managed super fund today. In 12 months' time, it was worth $3.5 million. You'd be paying tax. You haven't sold the property.
Is that right?
You'd be paying tax on that $500,000 gain, and you'll do that each year according to their formula, which is a unique formula designed for no doubt a number of reasons. One, to capture just the small percentage of Australians that are over 3 million, so that it doesn't have to be folded.
So when you say small percentage, approximately what would that look like? Under 5% or?
Yes, yeah.
So it's no more than 5%, roughly?
Yeah. I don't...
Something like that.
Yeah, it could be under 2%.
Could be under 2%, yeah. So, it's interesting.
Yeah. 3 million is an interesting number.
It is interesting.
I don't know whether that's... I don't believe that to be a large number.
No.
Definitely they've spoken about there are a couple of funds with tens of millions, one or two with hundreds of millions, and you could definitely argue, that's potentially
right.
a large number to be in a tax concessionally taxed environment. But then you get down to the 3 million number, that potentially, for the lifestyles these days, not a large number really, if you're talking about spitting out an income for yourself, your spouse, maybe you still got dependent children, or you're helping with university. Who knows what it might very well be? You've carried debt into later life. Yes. I think you could construe that for some people to be not a large number, and in actual fact, a uniqueness of this legislation they folded in, there is zero mechanism for indexation. They have no. A lot of the caps and things when they introduce them, they have indexation. Indexation applies according to this, that, or the other. This has no indexation. So this could very well be 3 million in 20 years' time, and it will be based on inflation. That could be not a lot of number by the time.
It's an interesting approach that the government takes, with these things, and they certainly have a I guess reason for decisions and why they haven't indexed it, and I think that there's something to do with the fact that they can just pull the trigger any time. If they need to make a change, they'll just push it through. It's also an election potential issue too, so to keep it open-ended, it's a lot of moving parts to these things.
So
isn't
that's
there?
how this would, but the 3 million cap would have to be increased, and could be by government introducing legislation. It wasn't indexed this year. We're going to up it to 3.2 or something. So
But just on that note, the $3 million threshold, is it basically just to fund the balance, or the members' balance across all members of the super fund, or just a single member?
a single member total super balance. So,
Total super balance,
if it was 2 people in an
it's over $3 million.
it'd be 6. It would be a number per se, but it's
Yeah.
3 each. It's
Yeah.
3 each.
Correct.
Yeah.
That's fine.
But your total super balance, which means super and pension.
And pension, correct.
Yeah.
Yeah.
So pension, which is currently tax free, superannuation income streams over 60, they're according to this as well.
Correct.
So if one partner's got 5 million, the other's got 2, then or say 1, you can just shuffle things around.
No, you can't shuffle super simplistically like that.
Yeah.
I thought you can. It's not. We're not talking about advice sort of stuff here, but in terms of shuffling money from partners' accounts, obviously it must be a bigger picture, more sort of things involved to be able
Yes,
to do that.
definitely.
Okay.
Yeah,
Not for
definitely.
this board,
So
probably,
there's
but
no
yeah.
quick fix. If you've got 5 million, you've got 5 million, and you're going to get taxed.
Yeah.
And if you've got 1 or 2 million, you're
fine.
You're fine.
So you can't top up the partner's low balance to bring it to.
You could potentially have if you're eligible for a withdrawal and the partner's eligible for contributions, but there are caps.
There are caps, yeah. Okay.
Caps.
Oh, that's good. Very good. We won't get into the details of that.
No advice there. No advice
No,
there.
thanks, David. Yeah, there's certainly no personal advice taken into consideration.
No.
Anyone's circumstances there, we're just generally talking.
Yeah, that's
Even though I'm
exactly
a
right.
financial planner, that's not to be construed as personal advice.
Exactly. Thanks very much, Kyle. Now, I guess we'll come to Blair in a sec because we're going to lead into interest rates after this conversation. I guess from my point of view, the biggest change for me personally, and I think with some agents, is that I'm carrying a lot of listings at the moment, probably about 18. And of those, probably a good number of them have been priced accordingly and accurately to reflect the current market, and the previous or the other ones are still priced in a way that's it's causing those properties not to move, which basically means they're priced too high and the vendors aren't willing to align at this stage. So my listings have gone up a fair bit, although I've had some very, very good sales over the last quarter. Certainly not record numbers, but very, very healthy. And as my business, I'm very happy with where it's at, given we've had 10 months of interest rate rises. Heading back to that conversation we talked about earlier, I planned a few months ago to looking at my super and thought that I'll put the brakes on my superannuation and wait to see how much money I'm left with in May. And I'm sure there's a lot of people out there doing that sort of thing, as we've talked about. Probably said this in the last meeting, the quality homes are still doing really well, they're still selling well, and there are no shortage of buyers with an appetite for those sorts of homes. In the last probably 2 or 3 weeks, I've had a ramped up inquiry on even land, and with people starting to adjust with their expectations on interest rates and interest rate ceilings and what that looks like for their budgets. And Blair might share with us shortly about if anything's changed in the serviceability space with lenders, but I'm finding that now buyers are starting to come out and go, okay, I'm starting to get quotes on building my new home. That was not really happening probably a couple of months ago or prior. So that's interesting, and since yesterday's interest rate announcement with a hold, whether it's a coincidence or not, my phone went really busy after about 3 o'clock till about 6 o'clock. And 2 requests for contracts, and properties that have been on the market for some time, just multiple inquiries just in the space of a few hours. So it's a funny thing how the market can turn and how we across the table experience it in real time. But I think things are definitely looking a little bit more promising in the property market space. However, I think it would be a bit too early to call, but it's just looking promising, particularly with some of the national figures coming out pointing to a 0.6% increase in the property market nationally in March, coming off the back of 10 months of straight decline. So have we hit the bottom nationally? I guess it's probably hard to say, but obviously each market's different, and you have markets like Adelaide, Darwin, and there's one other state too that's increased as well, and Perth. They've basically experienced growth, which is interesting.
Tony, what do your vendors think about, like, we're near 5% down in the last 3 months on dwelling values in Hobart alone?
Yeah, it's probably...
Does that worry you?
No, that's a good question, David. People generally aren't really worried about sort of small declines. I think obviously people want the best they can get out of their property, but the market dictates that, and the quality of the home sort of dictates that as well in a way. But people aren't generally worried, and they're realistic, and they understand that they've done well in over the last few years, so that's not really an issue. People were probably more worried a couple of months ago or 3 months ago when we just could not see an end in sight with interest rate rises, and no one could really predict. So to get to the point where we're at today, and from yesterday's announcement, which is positive, it certainly doesn't mean that we're finished up with interest rate rises, although some people probably think that might be the case. But it is still positive, and that positivity will flow through to the market, and I think it's flowed through into the ASX 200, things like that, and the share markets. So that's that from me. Days on market sort of come down a little bit, but still roughly nationally it's sitting at around 41 days. Hobart's, out to around 50 days actually, out to about February, 3 months to February this year, and back in the 3 months to the end of 2021 it was 20 days. So we might start to see that peg back a bit, I think, in the next few months. Yeah, so that's good news. Over to Blair now in the mortgage broking space. What's been happening at your end?
Lots has been happening. It has been an interesting time. Obviously, the variable rates stayed where they were in January, went up in February and March. They're on hold or pause for April. And the stability of people knowing what repayments will be in the future, I think, drives a lot of decisions. When they can see that things aren't going to stop, then they just sit on their hands, but as soon as there's stability, then they can make that decision on budgeting. So I've been doing lots of budgeting with people over the last couple of months just to go through their expenses and say, right, well, do you need to be spending your money on this and that? Because the serviceability is still quite an issue for the first home buyers. And they're the ones that at the moment that probably aren't able to get into the market because the servicing rate is still up around 8.5%, even though the interest rate might be 5.5%. So the real world compared to the bank world is a lot different. On the flip side, if you're in that position where you've got the ability to buy property, the properties are moving, and they are probably your double income, no kids, or established people on good incomes. And the big thing I've been saying to people there is, don't listen to the noise. Just concentrate on your own situation. If you can afford it and you can budget for it, and you've got your job and you've got the deposit to go into it, go for it. Because if it's going to be a 20-year home you're going to be living in, who's going to remember what you paid for it, down the track? So that's probably the people side of things. On the interest rate side of things, fixed rates have been reducing a little bit. So over the last week, Macquarie reduced some of theirs by 0.2. ME Bank came out this morning and reduced that as well. So as a leading indicator, which fixed rates normally are seen as, the economists of the banks, I guess, are seeing that we might be at a bit of a pause. Not to say that they won't go up in the future, because these interest rates can take 3 to 9 months to get into the economy. So some of the way the banks have do their reviews, it isn't done monthly. Some banks will only do it every 3 to 4 months. So the interest rate will go up, but the actual repayment won't go up for a period of time. So the Reserve Bank, I think, are just going to sit on that, wait until all of these interest rates have all actually moved and the banks have changed the actual repayments, and then see how things sit from there.
So how quickly, Blair, do the banks take to implement these interest rate changes?
So just to name a couple, ANZ and Suncorp, they will do them straight away. So if your Reserve Bank goes up on the 4th of March, normally within 2 weeks they've got their repayments readjusted, and you get the letter in the mail that says, okay, your repayment now is going to be X. Unfortunately, probably the biggest bank in Australia, which is the CBA, their systems aren't really made for monthly reviews, and it can take 2, 3, 4 months for the repayment on someone's loan to adjust. So even though interest rates have gone up, the actual cash flow repayment that needs to come out of your everyday account hasn't taken place. So there's still a few months of people that really haven't even felt the effect of the higher repayment from the last 3 months.
Interesting. No, that's interesting. In terms of interest rates, I guess, then I'll throw it around to the table, I guess. What's that going to do now in terms of them being put on hold? And some of us are a bit shocked by the announcement and some aren't. How long does it take before we start to feel the effects of an interest rate, decision? I think, Blair, you mentioned prior to the podcast that it can take some months.
Yeah.
Even for the banks to implement the change and just the general economic flow and impact. How long do we think? Can they stay flat for a little bit longer, or what's?
Well, no one's got the crystal ball, but I did hear this morning that the Reserve Bank governor saying inflation won't get down to 2 to 3% range until mid-2025. So there's 2 years of who knows what.
So the interest rates might need to hover around this 5, from a retail rate.
Yeah, well, they need. I'd be at least anything that I've been reading coming out is that rates may start to reduce later this year, but it could be 2024 until that happens in that space.
Is that what you think, Dave? What do you think?
Yeah, I think just like anybody in any business, you need time to assess, and I don't think they've had any breathing time to assess, and I think they've got to an end of a point where it hasn't, 10 in a row hasn't actually dramatically changed the country's economics in inflation or the cost of living expenses. So I think they've just pulled the handbrake, stood back and go, okay, if that's 1 or 2 months of let's see what it does, let's see how the 10 rises of interest rates, and what are the cause and effects, throughout the country. So I think it's a good thing. But is there still more to come? I think we shouldn't sit on our laurels, because there could be, just depending on how the country reacts over the next sort of 2 to 3 months. So 2025, getting inflation back in that 2 to 3% range, it's going to take some aggressive moves to get there. but I think we can see a little bit of rest ahead, maybe some up and down moving forward towards the end of the year.
Yeah, that all sounds good. You feel the same way, Albert? How do you feel about it?
Well, I think the interest rate, maybe stabilise for a little while, in a short period of time, maybe 3 to 5 months. And because of the, I actually personally thinking from maybe the world, perspective, even though, because we're talking about Silicon Valley Bank, and Swiss Bank as well, and the large amount of cash. The question is, the cash or the money is in the market globally, but where about it went? So then yes, Australian sort of economy probably follows the US really closely, a couple of years behind perhaps. But I think because the lags maybe became shorter, instead of 2 years behind, maybe a little bit shorter, a year or probably 6 months. So it really depends on who are the real stakeholders of Australian assets. Is it American sort of economy or stakeholders, or foreign stakeholders, or local stakeholders? So Australian interest rate still largely depends on overseas sometimes, not necessarily only national, domestically. When I think probably my guess, I wouldn't say predict because ups and downs no one knows. I think probably Reserve Bank maybe just to put on a break temporarily, wait and see, because they really need to gather a bit more information or real information, and they can make a decision. Otherwise, that's my personal opinion. Yeah.
It's interesting to say that's the Fed in last month increased their rates.
Yeah.
And traditionally, like you said, Australia follows the Fed.
But that time didn't happen.
So this time it didn't happen. So are they looking at data that we haven't seen yet? Hence our pause.
Yeah.
They are looking at their data, which is American inflation, and we're looking at our data, which is Australian inflation. And they have a slightly different inflation's run a bit harder in the States, and apparently I think their central bank has more of a mandate at going harder against inflation. But what might happen tomorrow with interest rates, and who knows? No one knows. What will happen tomorrow, no one knows. But David's point around having time to absorb things, I think, is very
Do you think
fair in this current
climate. Do you think the general sort of community or out there, do you think there'll be any changes in behaviour out there across consumers with, because I think, are people just starting to feel a bit more comfortable, do you think, or they will start to feel a bit more comfortable? I mean, I certainly feel like I'm feeling a bit better personally, given there was no end in sight with the rises. So I guess the question is, over the next, say, 3 months or leading into spring, if we just talk specifically Hobart, for instance, do you think we're going to see some buyer behavioural changes with spending or purchasing real estate or building, increased construction?
I'll jump in, Tony, there. It's with our clients and investors, we just move the dial on our purchase, our yield of purchase price. So if interest rates go up, instead of buying at 6.2% yield, we're going to buy at 6.5% yield. Rents are going up, 6 to 7% per annum at the moment. So rents are catching our yield increase we need for rate increase. So from an investor perspective, business as usual, because we're getting the rent increase. If rates stabilise like they have now, well, it's more appetite for investors. So because they're still getting their increase via rents. So I can see that, the inquiry coming through is now I'm just shifting the dial a little bit for the investor on a yield perspective, so they can then go to the mortgage broker and ensure they can hold that debt and manage that debt sufficiently. So I think there's some positivity there, and that might flow into spring.
Yeah. No, that's really good. Does anyone have any questions at all about anything? Any questions to ask each other or anything? We've covered a fair bit, I guess. Oh, good. So, so I think things will pick up in the Hobart market from a real estate angle. The angle that I'm coming in from, I'm feeling should pick up. I'm reasonably optimistic, but yeah, I don't have a crystal ball. But I think coming off the back of some of Sydney's market performance in the last 2 or 3 weeks, it's probably looking like the gap between our catch up from overseas to Australia and from Sydney to Hobart has shortened, and I think it's my personal take on it is that the world is a lot more connected than it was, so the time lags are a lot shorter, and they'll continue to probably be a lot shorter. So I think heading into spring we might see some positive growth in the market, nothing excessive, but certainly a lot more activity, less days on market, and possibly a reduction in stock. I think there's been a lot of stock hit the market over the last probably 6 months, and there might be a bit more of a tightening of that.
That's interesting. We're 9% up, I think, on comparable to last year.
Yeah.
New listings. So Hobart specifically 9% and a bit up. When we look at Sydney and Melbourne, they're double digits down.
Yeah, that's
So
right. Yeah,
It's a real change in mode here, and we can see we're 5% down in dwelling values in 3 months, and we're 12% plus down in dwelling values in 12 months.
yeah,
And it's not hitting the ground. Like when you talk boots on the ground, and I'm talking with buyers, they're not concerned that we're double digits down in 12 months. Vendors aren't concerned, and interest rates have been going through the roof. So, historically, when we in this type of emotion, we should be one party should be feeling upset, but we're not. So it's we're quite balanced out there. We've had a couple of 100% gains over the last 5 to 7 years in Hobart, so I think that's adding some strength to anyone who's selling, and a buyer's probably realise that you've got to pay to get in.
It's almost like with the market, you sort of set a new foundation. Things bubble up. You have big spikes, 30%. Then she drops off a bit, balances out. That's that new foundation for more new baseline, I should call it, for platform for future growth and things like that. So it's that's just how the cycles have worked. But just finishing off now, just the other interesting thing I noticed on the ABC with Alan Kohler the other night was a couple of statistics that were pretty interesting. One of them was that rents have gone up around 20% nationally over the last 12 months, which is coming onto your yield conversation. The rate of migrants coming in is about 1,000 a day, so that's quite significant on obviously on accommodation. That's a mix though of people on short-term visas and skilled workers. We don't really know how many will end up staying, but some of those will obviously want to apply to stay on. And I think you mentioned, don't quote me on this, but it was about 85,000 permanent rentals across the country, and 300,000 short stay across the country. So that's interesting, So there's not a lot of housing out there for the numbers, wanting to get in. And the government intervention on, their housing policies and projects, it's not moving. Well, obviously they can't move as quick as they need to, and we will find that this will impact the property market, maintaining, prices and attributing to further growth. Unfortunately for some, and fortunate for others. So I think that's about it, guys, for this quarter. That was really interesting. We'll wrap it up today, and I thank you for your time, and we'll look forward to quarter number 3. Actually, quarter number 2's conversation, which will be in first week of July, after the interest rate announcement in July this year. So we'll chat then, and hopefully we've got some good things to say. Thanks, guys.
Thank you.
Thank you.